You're in tune to the Paperflip Real Estate Podcast.
For the last few years, buying a home has felt like an impossible dream for way too many people. It's been this constant uphill battle against brutal interest rate hikes that push affordability off the cliff. So many of you are probably in that spot. You did everything right, you saved a down payment, your credit was solid, and then poof, goalpost gets moved. The monthly payment on the exact same house shot up by hundreds, even thousands of dollars. It was frustrating, it was discouraging, and it left a lot of people feeling totally sidelined from a huge life goal. But what if I told you that chaos is finally calming down? After a period of extreme volatility, we're entering a new phase, which is stabilization. In this video, we're breaking down exactly what that means. This isn't some fantasy about rates crashing back to 2%. And this is about something much more real and honestly much more useful for your planning. I want to talk about how today's stabilizing mortgage rates can lower your monthly payment, seriously boost your buying power, and ultimately make your dream home affordable again. We even run the real world math to see how a tiny half percentage change in your rate could be the key that finally unlocks the door to your new home. To really appreciate where we are now, we have to remember the painful journey that got us here. Feels like a lifetime ago, back in 2021, mortgage rates were at historic, almost unbelievable lows. People were locking in 30-year fixed rates at under 3%. That created a home buying frenzy, sure, but it also set a new standard for what we thought a mortgage payment should look like. Then the entire script flipped. To fight soaring inflation, the Federal Reserve launched one of its most aggressive rate hike campaigns in modern history. Now, a common myth is that the Fed directly sets mortgage rates. They don't. The Fed controls the rate banks charge for what they charge each other for overnight loans, but that sends a massive ripple effects through the whole economy, especially the bond market, which is what mortgage rates are tied to. Now, as the Fed tightens its grip, mortgage rates didn't just climb, they shot to the moon. We saw the average 30-year fixed rate jump from under 3% to over 4%, then 5%, then 6%, and by late 2023, they peaked at over 7.5%, a level we hadn't seen in decades. This crazy fast ascent was brutal for the housing market for two big reasons. Now, first, it created what's known as the lock-in effect. Now, think about it. If you're a homeowner sitting on a sweet 3% or 4% mortgage, why on earth would you sell your house just to buy a new one at 7%? You wouldn't, and people didn't. This made housing inventory totally dry up. Supply of homes for sales vanished because sellers were trapped by their own great mortgage rates. And second, and this what hit you, the buyer, the hardest, was the affordability crisis. You had this perfect storm of high home prices left over from the pandemic boom and these insane new interest rates. A house that was maybe in your budget in 2021 was suddenly a pipe dream in 2023, even if the price tag never changed. The income needed to qualify for a typical home just exploded. It was a fundamental shock to the system that priced out millions of hardworking Americans, especially first-time buyers who didn't have equity from a previous home to lean on. It's been a tough, volatile, and deeply uncertain time to be in. So what does stabilizing actually mean? After all that chaos, what do we mean when we say rates are stabilizing? This is the most important part to get right because it's all about realistic expectations. Stabilization does not mean a dramatic rate crash. We're not going back to 3% anytime soon. Let me say that again. The era of 3% mortgages is over, at least for the foreseeable future. What stabilization does mean is that wild, unpredictable weekly swings are finally calming down. Instead of rates jumping a quarter or a 0.5% out of nowhere, they are now moving in a much tighter, more predictable range. As of mid-2025, the average 30-year fixed rate is hovering in a band between roughly 6.5% and 7%. Yes, that's still high compared to 2021, but the key word here is less volatile. So why is this happening? A few things. The Fed, seeing that its rate hikes did their job cooling inflation, has switched from an aggressive stance to a more cautious wait-and-see mode. They signaled the big hikes are done. This brings a sense of calm to the bond market, which hates uncertainty more than anything. And when the Fed plans is more clear, investors can price things more accurately, leading to less drama in mortgage rates. Think of it like this. For a couple of years, the Fed was slamming on the car brakes to keep inflation from crashing. It was jerky, violent, and uncomfortable for everyone. Now they eased up. They're not hitting the gas yet, but they're tapping the brakes gently, making small tweaks and trying to coast to a smooth stop. That smooth ride is the stability we're finally feeling. Forecasts from groups like Fannie Mae and Mortgage Brokers Association mostly agree on this. They project rates will likely hang out in the low mid 6% range for the rest of 2025, with only small gradual declines. We still see small ups and downs based on job reports or inflation data, but the huge market shaking leaps seems to be behind us. This new predictability is a game changer for you as a buyer. It means you actually can plan. You can look at your budget, get pre-approved, and be reasonably confident that the rate you quoted today will be in the same ballpark in a few weeks. That just wasn't possible a few years ago. So this is how stability directly lowers your monthly payment. So all right, let's get to the good stuff here. How does this shift from a crazy high rate to a stable, slightly lower rates actually help you, the buyer? The most direct benefit is the hit to your monthly mortgage payment. The difference between a 7.5 rate and a 6.75% rate might not sound like a lot, but over 30 years, it's massive. Let's use a real world example here. Now, the median price home in the United States is somewhere around $420,000. Let's say that the home you're eyeing is around $420,000. Now, with a 10% down payment of $42,000, you're looking at a loan of $378,000. Now, time for some quick math here. At the peak rate of 7.62% in late 2023, your monthly principal and interest payment on that loan would have been roughly $2,700. Now let's fast forward to today's more stable world. At a 6.8 mortgage rate, that same $378,000 loan has a monthly payment of about $2,455. That is a savings of $245 every single month. Let that sink in for a minute. That's nearly $3,000 a year back in your pocket. That's a car payment. That's a huge chunk of a family's grocery bill. It's the difference between being stretched to your absolute limit and having some breathing room. That money could fund your home maintenance account, pay for utilities, or just be a little extra security for your future. And what if rates continue to drift down slowly, like many experts predict? If you manage to lock in a rate of 6.5%, your payment on that same loan drops to about $2,389. Now you're saving $311 a month compared to the peak. Now that's over $3,700 a year. This is a real tangible benefit of stabilization. Every tiny decreases have a huge impact on your daily life and your ability to build wealth long term. A lower payment makes it easier to qualify in the first place and means more of your money goes towards your principal each month, building equity faster. This isn't just a numbers game. It's about making home ownership a comfortable reality, not a constant financial nightmare. If you're finding this breakdown helpful, and if you're starting to see a path forward for yourself, do me a favor and hit that like button. It tells YouTube, tells the algorithm that this is some good stuff, and it helps get the video out to more people who are trying to figure all this out just like you. It really does make a huge difference. So let's go into unlocking your buying power, the income factor. Lowering your payment is one thing, but stabilizing rates have another equally powerful effect. They directly increase the number of people who can actually qualify for a mortgage to begin with. Lenders are strict, and they use something called a debt-to-income ratio to decide how much you can borrow. Key rule of thumb is that your total housing payment, which is principal, interest, taxes, and insurance, shouldn't be more than about 28 to 30% of your gross monthly income. Now, when rates go up, the interest part of that payment goes up, meaning you need a much bigger income to stay under that 28% ceiling. This is exactly why so many people got shut out. But now the reverse is happening. As rates stabilize and gently fall, the income required to buy that same house starts to come back down to earth. Let's get back to our median price home. The data shows that to afford a median price home with a rate around 7%, a household needs an income of about $126,000 up to $147,000. But here's where it gets kind of wild. One analyst showed that when rates dropped from the peak of 7.62% down to 7%, an extra 2.8 million households in the United States could suddenly qualify for a mortgage on a median price home. That is a massive number of people who were locked out and now are back in the game. Now think about it. At the peak rate, you might have needed an income of about $155,000 to qualify. But as the rate comes down to 6.8% or even 6.5%, the required income to meet the lender's rule also drops. A family that was told no 9 months ago could very well get a yes today without getting a single dollar raise. This is what we mean by increasing your buying power. It's not just about the payment feeling better. It's about clearing the first and most important hurdle, and that's getting approved. This is a huge deal for first-time home buyers who are often right on the edge of qualifying. While everyone else is sitting on the sidelines waiting for rates to magically hit 4%, the smart buyer sees that this shift from 7.5% down to the mid-sixes is the real window of opportunity. It's the change that reopens the door. Now, what you can control, this is a practical action plan. It's what you can control. Now, the market is giving you an opening, but you have to be ready to jump through it. We can't control the Fed, but there are several things you absolutely can control to put yourself in the best possible spot. First, your credit score. This is your superpower. The rates you see advertised are for people with top-tier credit. A lower score can easily add 0.5% or more to your rate, which we've already seen is a massive deal. So to get obsessed with your credit is something that you really need to be doing nowadays. Get obsessed with credit. Pay every bill on time. Pay down high-interest credit card debt to lower your credit utilization. Pull your credit report, check for errors, and dispute them. Getting your score up by 30 to 50 points can save you tens of thousands of dollars. And second, your down payment. Now, the more you put down, the smaller your loan and the lower your payment. It can also help you dodge private mortgage insurance, which we call PMI. Look into down payment assistance programs in your state or city. There are thousands of them out there, and most people who qualify don't even know they exist. And third, know your loan options. The 30-year fixed rate is king, but it's not your only choice. Ask a lender about a 15-year mortgage if the payment is manageable. You'll save a fortune in interest. Or consider adjustable rate mortgage, which we call an ARM, which starts with a lower rate for your first 5, 7, to 10 years. Now, ARM can be a great strategic move if you don't think you'll be in a home forever. This brings us to that popular saying in real estate right now: marry the house and date the rate. Find the right home now, get the best loan you can, and then refinance a few years if the rates do fall further down. And finally, and this is a non-negotiable, shop around. Do not just walk into your bank and take what they have to offer right off the bat. Get quotes from at least 3 to 5 different lenders, national banks, local credit unions, and independent mortgage brokers. This is one of the easiest ways to save money for yourself. The difference between lenders can be 1/4 to 0.5%. Be a savvy, informed shopper when you're out there looking for rates from these lenders. The housing market of the last few years have been a wild ride for a full basket of anxiety. But we are finally turning the corner into a more hopeful chapter. Mortgage rates are stabilizing. The chaos is calming down, and rates have found a more predictable home in the mid to high 6% range. Is real possible nowadays. This stability is creating a critical window of opportunity for yourself as a home buyer. No, it's not a return to the crazy lows of the past, but gives you 2 huge real-world advantages. It lowers your monthly payment, giving you breathing room in your budget, and it lowers the income needed to qualify, putting the dream of home ownership back in the reach for millions. Affordability is still a challenge, and home prices are still high, but the trend is finally moving in the right direction for buyers. Predictability is replacing volatility, and that gives you the power to plan with confidence. The secret isn't to perfectly time in the market. Nobody ever does. The secret is to focus on your own readiness. If you've been on the sidelines, now is the time to get back in the game. Run the numbers. Talk to a lender. See what's actually possible for you in today's market. This period of stability might just be the chance you've been waiting for to finally make home ownership your reality. Now I want to hear from you. What are you seeing in your local market, where you stay at, in your city and in your town? Are you feeling more optimistic about buying a home now that things have calmed down a bit? Things are starting to stabilize. Drop a comment below and let's get a conversation going. And if you want to stay on top of the latest housing market trends, make sure you subscribe and hit that notification bell so that you don't miss out on a thing. Thanks for watching, and I will see you on the next one. This has been Lloyd for Real Estate.